Hi, my name is Ruth, and I am here to talk to you about understanding 1031 exchanges and how to rescue a failing exchange. My name is Ruth Benjamin. I am a tax strategist. I'm currently the general manager of National 1031 Exchange Services. I've worked in the title, escrow, foreclosures. I did evictions. Worked for the bankruptcy department, the mortgage loan assistant, and a legal assistant. But I spent 28 years of my career as president of two different 1031 accommodator companies, and I have also been in the credit repair world. So we're going to talk today about Internal Revenue Code Section 1031. So the Internal Revenue Code Section 1031 tax deferred exchange represents a legal strategic method for acquiring or selling like-kind or qualified properties in order to defer capital gains tax. If you meet the prescribed criteria as established by the Internal Revenue Code, then capital gains taxes may be deferred by exchanging property. Now, exchanges have been around since 1921. That's where I had a property you liked, you had a property I liked, and we swapped properties. But it wasn't until 1979 that T.J. Starker sued the IRS and won, and that's how we came up with IRS Section 1031. So a lot of people will ask me, what is like kind? That seems to be the main question. People think because if they have a condo, they have to buy a condo. Well, in reality, let's go through like kind. All of these can be interchangeable. So if you have a single family residence, you can purchase a condo. You can purchase industrial buildings, golf courses, retail space, farms and ranches, hotels and motels, leases with 30 years or more remaining. And that's where if you own property in a state that you don't own the land, you lease the land. Before you do any type of tax deferral strategy, you need to make sure there's 30 years or more remaining on that lease so it is considered real property. Then you can also exchange for multifamily rentals, offices, land, tenant in common, and Delaware Statutory Trust. The things that do not qualify as like kind is your primary residence, and we're going to talk about that later on in this presentation, and second homes. We're going to show you how to make them qualify for 1031. So also people that are flipping property, so you're buying, fixing, flipping, right? Or developers who are buying land to build homes and sell them, they do not qualify for 1031 because the IRS wants your intent to be that you're holding the property for investment use. So if you're a developer or you're flipping, you are in no way thinking of holding that property for investment use. So REITs typically are a membership interest in a trust and are not exchangeable unless the REIT is considered real property and not a partnership interest. You can exchange anywhere within the United States, including U.S. territories. Let's talk first about the reverse exchange. The reverse exchange is where you buy your new property first. You buy it with cash or a new loan. We could take title to the property you currently own, or we could take title to the new property that you want to purchase. And when we enter into a reverse exchange, we create an EAT. The LLC is an EAT. The EAT is an exchange accommodation title holder. You must sell your property in a reverse exchange, the one you currently own, within 180 days, or you're going to end up owning two properties, and then there's no way to exchange into it. But I'll talk to you about another strategy that could help you out if you got stuck with two properties that you didn't want. The safe harbor reverse is the safest. Some companies will do out of safe harbor, but you must have an attorney involved, and typically you should have counsel no matter what type of transaction that you are doing. And the cost for the reverse exchange is anywhere from $4,500 to $10,000 plus, depending on how complex the transaction is. The advantages of the reverse exchange is you can close on the replacement property without a contingency of your old property selling first because you're going to buy the new one with cash or a new loan, and you don't have to worry about the 45-day identification period because you already know what property you're going to sell in order to finish this exchange. The drawbacks are you have to acquire the replacement property without having the proceeds from the sale of your property. And financing issues come up. If you want us to take title to your replacement property, but you're getting the loan, a lot of times the lenders have an issue with that you're getting the loan, but we're taking title. So that makes it where we have to take title to the one that you are selling. And of course, there's the additional cost of the reverse exchange. And we may require an environmental report, but not for 1 to 4 unit residential properties. So let's talk about the next type of exchange is a build-to-suit exchange. Now, a build-to-suit exchange, the problem with it is that you cannot own the land that you want to build on. So you cannot take one of your investment properties, that cash, and build on a property you already have title to. They don't allow you to do that. So you must identify the improvements and the land by the 45th day, and you must take title to that new property fully finished within 180 days, which is a really tough thing to do, and you must have an occupancy certificate. So basically, what I tell people, if you can't get finished within the 180 days, do an appraisal on the property. Make sure that if the IRS tries to tell you it was worth less when you took title to it, that you have an independent licensed third party that tells you what that property was worth. So the reverse exchange, again, is about, or it is possible to do a build-to-suit reverse. So build-to-suit or a reverse build-to-suit, you're still looking at the higher end cost of 1031 exchanges. So let's talk now about the most common exchange done, which is the delayed exchange. And again, as I said before, always talk to a tax advisor before entering into any type of tax deferral strategy. So you're going to list your property for sale. Once you get a buyer for your property, you're going to open escrow with the title company, or if you're on the East Coast, with the attorney office. Now, there must be the exchange verbiage in the contract that the IRS requires. And basically, all it says is the seller is going to do a 1031 exchange, defer their taxes. The buyer agrees to cooperate. There's no additional cost or liability to the buyer. I do have sample verbiage. If you need it, you can reach out to me. So when you open that escrow or open the order with the attorney, you need to get your exchange started right away. Open it with the qualified intermediary. Sometimes I'll use the word qualified intermediary. Sometimes I use the word accommodator, but it means the same thing. So with us, what we ask for is a copy of the purchase agreement. We ask for a copy of the preliminary title report or the title commitment if you're East Coast. And what we do is we prepare our exchange agreement and we send it to the closer. And that way you can sign your exchange agreement at the same time that you're signing everything else. Now, you will still deed your property to your buyer. It used to be a day that the accommodator had to take title to the properties, and you would pay additional transfer tax and recording fees, but that's not the way it is today. The IRS allows direct deeding, so you don't have to pay those additional costs. So once you close on the property, so if you close today, the time clock starts tomorrow. So you have 45 days to identify the replacement property, and you have up to 180 days to take title to that property. The cost of a delayed exchange is very minimal. If you have any property under the value of $500,000, you're looking at $500. Any property that is $850,000 or less, you're looking at $850. Once you get up to the $1 million price, it's $1,000, and then it's $500 for each additional million. Now, these fees cover up to 3 properties, so you could sell one and buy 2 replacement properties. So let's talk about deferring 100% of your capital gains taxes. I'm going to show you an example. If you sell a property for $1.8 million, you must buy a property or properties worth $1.8 million or more. If you have $1,125,000 in equity, you must roll all that equity over to the replacement property or properties. If you have a loan on the property you're selling for $675,000, you must have a new loan of $675,000 or more. That's in order to have a fully tax-deferred exchange. Now, if you want to pay some taxes and defer some taxes, that's a partial 1031. So if you had your $1.8 million sales price and you only bought a property for 1.4, then you took all your 1,125,000 equity and rolled it over to the new property, but you ended up with a loan of 275,000 instead of 675,000. Now you have a trade down in two areas. You have a trade down in the sales price and you have a trade down in the loan amount. So what the IRS is going to do is they're going to tax you on the greater of the two. So let's talk about these crazy rules that come with 1031 exchanges. So the first rule, and the very first thing, if the IRS audits you, they're going to look at your identification form. So the designation form, they're going to make sure that you identified by the 45th day. So you must identify potential replacement property by midnight of the 45th day from the date of the sale. So potential replacement property. You don't have to be under contract. You just have to say, I like this address, and list it. Then you must acquire one of the properties you identified on that form by midnight of the 180th day or by the time you have to file your taxes. So just know that there might be a chance you have to file an extension to your tax return in order to get to your full 180 days. So the full time period is 180 days. The 45 day falls in that 180 days. So once the 45 day hits, you identify, you have the additional 135 days to take title to one of those properties. If you're selling two relinquished properties, then the clock starts when the first one closes. You got to get the second one in to buy your replacement property if you're going to sell two to buy one. So the clock doesn't start over for the second property. You have to go by the timeline of the first one. So the crazy rules when it comes to identification, the most common rule that people use is the 3 property rule. And that's just saying you can identify 3 properties and it doesn't matter what the value is. But remember, you still have to meet your equal or greater requirement. Then if you have to identify more than 3 properties, you may identify an unlimited number of properties provided that the fair market value of all the properties does not exceed 200% of the fair market value of the property you sold. So what does that mean? Let's make it real simple here. If you sell for $1 million, you identify more than 4 properties, the total value of what you identify cannot go over $2 million. Now there's one little thing I want to bring up is if you're in a crazy market where people are getting higher than the purchase price, when they list their property, they get over asking price, right? Well, if you listed a property on your identification form and you're right at the 200% rule, but you had a buyer offer more money for that property, it could kick you out of that rule if the IRS gets deep enough and checks it. You don't want to get stuck with that. So be really careful when identifying. If you do go over the 200% rule, then the 95% rule kicks in that says you need to buy 95% of the value of what you identified. So the identification must be made in writing and use a distinguishable address or a legal description. And you can identify to any party that's a party to your transaction, but not your real estate agent. So your attorney or your broker. But the safest to identify to us, the accommodator. Then the other crazy rule I like to bring up is the suggested holding period. Remember, this is suggested. It's not set in stone, but the IRS likes to see that you hold a property for 2 years, and when you buy the replacement property that you hold it for 2 years. That's kind of the comfort zone. So it's not a requirement. People do it all the time with less time held, but if you want the safe zone, then go with 2 years. Now, related parties, when you cannot buy from a related party unless the related party is also doing an exchange. So when selling to a related party, the related party must hold the property for 2 years or it will disallow your exchange. So what does that mean? If you have a rental property and you sell it to your brother, you met all your requirements in your exchange, you found a property equal or greater, you identified it by the 45th day, you acquired it by the 180th day, you moved all your money over there, you got the loan in place, you did everything right in your exchange. If your brother sells that property before 2 years, he just disallowed your exchange. So make sure if you enter into a contract with a relative that you put in that contract, if they sell it before 2 years, they're going to pay your tax bill. So related parties are brothers, sisters, spouses, ancestors, and lineal descendants. Related parties do not include step-parents, uncles, aunts, in-laws, cousins, nephews, nieces, and ex-spouses. Be careful if you have corporations and LLCs and you own more than 50% of the stock. You're going to run into related party issues if you start transferring properties between your corporation and yourself as an individual. Now, if you take cash from a transaction, it is called boot. Boot is just another term for a taxable event. So if you take cash out of a transaction, you will pay taxes. Now, in my example, mortgage boot can be offset by cash. So in my example where I said you had a $675,000 loan, but you ended up with a $275,000 because you traded down. Well, let's say that you decided you don't want a loan on there. You're just going to bring in cash. Cash offsets mortgage boot, okay? But if you pull cash from the sale of your property and you identify your replacement property and then you say, Ruth, I'm going to bring that cash back in because I don't want to pay the taxes, it's too late. You cannot offset that cash. If you pull it out, you're going to pay taxes. No way around it. Now, if you start an exchange, all accommodators have to hold your funds till midnight of the 45th day. So if you start an exchange today and call me up in 2 weeks and say, I'm going to pay my taxes, I don't want to do an exchange, I cannot let the money go. No accommodator can let the money go until the 46th day. Now, if you identified a property by the 45th day, and now we have to hold it till the full 180 days, so we can only release on the 181st day. So know that rule before you enter into any type of 1031 exchange. Now, a lot of people think that they can move into their rental property, convert it to a primary residence, and then get their exclusion, $250,000 for a single person, $500,000 for a married couple. It's not that simple. You must own each of the relinquished property and replacement property for 2 years. Then when you go to sell the primary residence that came from a 1031 exchange, you must be on title for 5 years. So the longer you live there, the bigger the proration gets. However, the depreciation recapture tax will never go away. So let's illustrate. Let's assume married taxpayers exchanged into a single family residence, rented it for 3 years, moved into it and lived in it for 2 years, and then you realize a gain of $500,000. So the exclusion would be prorated between the qualified use and the non-qualified use. The numerator is the period of the non-qualified use and the denominator is the number of years the property has been owned. So 3/5, 3 out of 5 years that you rented it of the gain, the $300,000 would not be eligible because that was rental time. Now, 2/5, 2 out of the 5 years that you did actually live in it of that gain, $200,000 would be eligible for the exclusion. As a consequence, you would pay taxes on the $300,000 plus the depreciation recapture tax. Now, some people rent out rooms in their primary residence. I had one client that had a doggy bakery in her primary residence. So when she went to sell, she used the primary residence exclusion and then a portion of it as 1031. As long as you plan on using the new house as a doggy bakery or you're renting out a room, you can use Section 121 and 1031. Second homes, I told you before they wouldn't qualify, but let's show you how you can make them qualify. And by doing that, you have to back off the usage. So don't use it more than 14 days a year or not more than 10% of the time that you have it rented out. So if you rent your property out for 300 days a year, now you can use it for 30 days a year. The beautiful thing is working weekends don't count towards that usage. So if you go to your property and you change the light bulbs, paint a wall, fix a faucet, go to that local hardware store and get a receipt that shows you went to the property to work on it for that weekend. Partnerships when it comes to 1031 exchanges are you really have to be careful with, because if you own a property in a partnership and the partners want to go their own way, you must dissolve the partnership 2 years before you can exchange the property. Now, we create partnerships and LLCs for asset protection. So if you dissolve it 2 years before you sell, you're leaving yourself exposed. So if one of the partners wants cash and one wants to 1031, then one of the partners can buy out the one who wants the cash. Now the partnership can stay intact and do the 1031 exchange. Now the IRS does not like drop-in swaps. Drop-in swaps means you drop out of the partnership and then immediately exchange. People do it all the time, but they don't like it, so make sure that you really get some legal advice before doing a drop-in swap. Now, the same taxpayer who transfers the relinquished property must acquire the replacement property. So there are some exceptions. A disregarded single-member LLC, the sole member is the same, okay? Grantor and a grantor revocable trust, living trust, is the same. If a taxpayer dies and the exchange has a estate or the trustee completes the exchange, that is okay. So let's give you some examples. If you sell as a partnership, you must buy as a partnership. Same thing with corporation. You must buy in the same corporation. Now, if you have title under a trust, but your lender says they won't loan to a trust, you have to loan to you as an individual, that's okay. As long as it's your trust and then you or husband and wife are considered one, okay? So you can sell as the trust and buy as individuals. Now, if you're selling as John Jones, you can now create a single member LLC and hold the property as the single member LLC on the replacement property. Or if you have 100% interest in one property and then you go and buy an interest in a second property, as long as you meet your equal or greater requirements, that's good. You could do that. After you finish your exchange, your tax person's going to file the IRS Form 8824. On that form, they want to know what you owned, what you bought. Did you meet your timelines, 45 days, 180 days? Did you meet your equal or greater requirements? Most tax people know how to complete this form. This is done quite often. Now, you have to acquire your property by the 180th day. So any transaction that closes after October 17th, your 180th day is going to be after April 15th. So if you need the full 180 days and it's past April 15th, file an extension to your tax return. Now, 15% incidental property. This is a rule that most people don't talk about, but it's very important because incidental personal property can be acquired with exchange funds for part of the purchase price of the replacement property without putting your exchange at risk. But to the extent that the exchange funds are used to buy that personal property, gain may be triggered since the personal property is not considered like kind. So if you're buying a house that has furniture fully furnished, make sure that the furnishings do not go over 15% of the purchase price. Because if you go over 15% of the purchase price, you can invalidate your whole exchange. So if you have personal property involved, make it a whole separate contract. Do not use your exchange funds to buy that personal property, because you're creating a taxable event. Now, deposits and rents, same thing. If you're an apartment complex owner and you have all these rents and deposits sitting in your bank account, but you have the escrow give credit from some of your sales proceeds to give to the buyer, and then all of a sudden you have this money sitting in the bank account, the IRS is not going to let you get away with not taxing it. So what you need to do is bring your rents and deposits into the escrow, let them credit it to the buyer that way, so you don't create a taxable event. Choosing a qualified intermediary, besides the strength of the intermediary, make sure they're bonded and insured, which of course we are. It's like choosing an escrow officer or a real estate agent. Who does good work for you? Who answers the phone? Who responds to your emails and can answer your questions? Who has a creative mind to help you get your deals closed? And I believe if there's a will, there's a way. We're going to figure out a way. You tell me what you have, what you want. We're going to work on it. I can contact the attorneys that I work with. One of them even co-writes laws with 1031 exchanges. So I'm going to do my best to help figure out a way for you to accomplish your goals. And I already said our attorney is ranked in the top 10 in the industry and has participated in getting laws written and passed in this industry. Now, the most common reasons 1031 exchanges fail. I'm hearing this all the time. Not enough inventory, multiple offers, inability to qualify for a loan on the replacement property. You know, some people take forbearance on their loans and it stops them from getting a new loan. It's not in all cases, but it has happened. Or the sellers lost their job and can't qualify for a new loan. Or maybe you started up a new company and haven't been paid yet. So think about those things before you enter into the 1031 exchange. I had a transaction where the client identified one replacement property and it burned down. It was past the 45th day. They didn't identify any other property and they ended up having to pay their taxes. I also had a situation where the seller of the new property went in the hospital and everything could not close, and it caused our clients to have to pay their tax bill. So I really suggest you identify more than one property. Have a backup. All right, so if you had a property worth $1.8 million, you bought it for $450,000, you put $200,000 worth of improvements, you have depreciation recapture tax of over $51,000, you're subject to capital gains taxes of $1,248,181.82. The federal government wants 20% of that. The state of California wants 13.3%. Then there's net investment income tax. People know it better as Obamacare. That's 3.8%. So if you sold this property without any tax strategy, you're going to be writing a check to the IRS for over $514,000. Now that's a huge check to write. Most people would be in tears to have to send that to the IRS. Now, 40 to 60% of exchanges are failing right now. It's pretty common through all the years of me doing exchanges that people are just not finding the property they want. And so many times clients often tell me that if they knew what they were going to end up with, they would have never sold the property that they had because the property they had was better. So what happens when an exchange fails? You're going to end up paying the taxes when the tax return is due, but there's a solution. There is a legal review on transitioning funds from Section 1031 to IRS Section 453. This memorandum is on our website, deferthegainstax.com. You can take a look at it, but set yourself up for success. Hire a 1031 accommodator that's going to give you options and release the funds to an installment sale. And this is what the clause says in our exchange agreement. By initialing below, the exchanger, which is you, agrees to accept the exchange funds with the net proceeds in the form of an installment note issued by NES, which is us, National Exchange Services, on terms and conditions to be agreed to by the exchanger and NES within 15 days after the termination event. The termination event is either you can't identify by the 45th day or you don't want to buy anything that you did identify. Then we had the capital asset dealer that is another form of a 1031, not 1031, but they're another form of an intermediary that takes an assumption to the exchange agreement and then allows you to move into the monetized installment sale, which I'm going to tell you about next. The most commonly used 453 options to rescue the failing exchange is the monetized installment sale. That is my favorite strategy for clients, and the Office of the Chief Counsel of the IRS issued a memorandum supporting the monetized installment sale back in August of 2012, and the IRS said that the monetized installment sale was good for the client and good for the economy. The monetized installment sale defers capital gains taxes, depreciation recapture taxes, and debt over basis taxes for 30 years. The cost is 6.7% of the net sales proceeds before any loan is paid off. And then there's a $300 fee it's an annual fee. Every January, you're going to get a statement for $300. And that keeps the processing escrows open. So the seller, which is you, is in full control of your funds. You can invest this money in business or financial vehicle of your choice. You must use the funds for business or investment purposes. Otherwise, if you use it for personal reasons, you're going to create somewhat of a taxable event because you should not write off the interest when you use it for personal reasons. Now, the items, the assets that you can use for monetized installment sale is real estate, a business. Now, you can't 1031 a business anymore unless it's got real property involved, but you want to allocate most of your business to goodwill because that's the part that you can defer the tax. Your equipment, inventory and equipment, that's ordinary income tax. So you would still have to pay the tax on that portion of the sale. You can monetize an airplane, a boat, stocks, cryptocurrency. If you carried back a note for a buyer and you're getting paid off and you don't want to pay the taxes on it, we can move it to the monetized installment sale. Now, the deferred sales trust is out there, and we like to talk about all of them because, it's not, this one I'm not a fan of, but we want to tell you about it so you get to make your choices. But you're going to pay taxes on the deferred sales trust, not Delaware statutory trust, on the principal as it's collected, and that's determined by your contract. So the cost of the deferred sales trust is 1 to 2% typically at close and 1 to 2% annually. Carry that for 30 years and you're going to see a lot more money paid out than just the 6.7% for the monetized. Now, it's managed by an independent trustee. So you do not have control over your funds. That's the part I don't like about it. You're relying on somebody else to make the right decisions over your funds. So it's as easy as 1, 2, 3. Set up a 1031 exchange with an accommodator that will cooperate with the monetized installment sale. The capital asset dealer, that's the name that runs the monetized installment sale, and they're a form of an intermediary. Then look for the 3 properties. We do suggest that maybe identify a Delaware statutory trust, not the deferred sales trust, as one of your properties. They're regulated by the SEC. And you can get passive income off of your Delaware statutory trust if you want. But if nothing looks good, nothing acceptable comes together, then rescue your failing exchange with the monetized installment sale. Then the capital gains taxes, the straight line depreciation, and the mortgage over basis taxes will be deferred for 30 years. So all of this hinges on you hiring the right 1031 accommodator to begin with. I am one of those accommodators, but let's plan ahead and eliminate the need for 1031 exchanges. Our Dynasty Spendthrift Trust has a private letter ruling. Everybody says, I already have a trust, but you don't have this type of trust, okay? It is, the private letter ruling came out in May of 2015 supporting these types of trust. So this unique type of trust is designed to protect your assets, to eliminate, reduce, or lessen taxes. It also eliminates liability and provides for beneficiaries without legally affecting the corpus of the trust. The corpus of the trust is not subject to turnover orders by any court or judge, whether federal, state, or local. It adds extra liability protections that living trusts and LLCs do not. The cost of this Dynasty Spendthrift Trust starts about $39,000, and that will lower your passive income tax bill. It will give you ironclad asset protection. It will defer your federal capital gains taxes for generations, hundreds of years. Okay, it will, if you have active income, you can set up a second trust that will lower your active income tax bill as long as you're self-employed. It doesn't help for W-2 income employees. So reach out to us on that. We have a whole presentation regarding the trust on our website. So please go to our YouTube channel, and you might be hearing this on YouTube, but hit subscribe. We're going to be putting a lot of videos out, especially on different tax strategies we don't even do webinars on, but we're going to start putting them on our YouTube channel. When you do that, you will get $100 off your next exchange. If you would like us to give a presentation to a group or an office or something, that group that you want us to give this information to, reach out to my partner Scott Varney and we will set that up. There's no cost for it. And here is my contact information. If you have any questions, please reach out. It's free information. So give us a call, send me an email. Even if I'm not working on your exchange and you have a question that you're not quite clear on, I would be happy to talk to you about your transaction. So I want to thank you for being here with us today.